There we go. So thanks everybody for joining us tonight. I just wanted to let you know that our chat is being recorded today, and that's so we can add it to our website. So those of you that couldn't join us today can watch it, or if you miss any details, you can rewatch it. And also I wanted to let you know that this is just going to be some general overview with this presentation that Brian's giving. And we're not giving any specific investment advice. You can always call our office after or email any questions. And I just wanted to introduce Brian Levitt. He is the Global Market Strategist at Invesco. He's responsible for development and communication of the firm's investment outlooks and insights. He has appeared on CNBC, Bloomberg, Yahoo Finance. He's been quoted in Barron's, Financial Times, and Wall Street Journal. He has been with Invesco since they combined with an Oppenheimer funds in 2019. And he was with Oppenheimer funds since 2000. Did I get that right, Brian?
Well done. That is correct.
I'll let you take it away.
Thank you very much. Everyone, thanks so much for joining. I'm going to spend some time walking through our views on what's going on in the world and provide a framework to think about where we go in the future. You may have noticed it's been an interesting start to the year with volatility in the markets, equity markets selling off short of the last 3 days. And, you know, it's funny, whenever we're in good times, people always ask me, when is the market going to become more volatile? When will we see drawdowns in the market? When are we going to experience corrections? And my response has always been that volatility, drawdowns, corrections, they don't just happen out of nowhere. They're almost always the result of policy uncertainty, whether it's policy from the federal government or whether it's policy from the nation's central bankers. And if you think about where we are right now, inflation is very elevated in this country. And as a result, the US Federal Reserve has set forth on a path to what will be significant policy tightening, meaning raising interest rates at the short end fairly significantly over the year. And so investors are struggling to assess what that means for the global economy and what that means for markets. And so for good reason, markets have been volatile. It's been pretty true to course. Volatility comes when there's policy uncertainty, which is precisely what has been happening. The good news, if you start to poll investors and you ask them, are you bullish or are you bearish? And you subtract the number of bulls minus the number of bears, the level has gotten as weak as it pretty much ever gets. We're back down to pre-COVID levels. I'm sorry, we're back down to early days of COVID levels. The last time we'd seen it that low before that was during the height of the US-China trade war. So you want to see that level of pessimism. It starts to suggest that things have gone a little bit too far. We've gotten a little bit too pessimistic. And so to me, it comes as no surprise that the market has bounced and has done better over the last few days. But nonetheless, and let's be clear, we still have some challenges to work through. So the way I like to present, I like to ask and like to bring up the questions that I believe we need to always be asking ourselves. First and foremost, where are we in the business cycle? Meaning, are we having a recession? How much time does this business cycle have to go? Second, directionally, where is the economy heading? Third, what's policy going to do? Which of course is the big one. Fourth, what are the risks to the outlook? I'm going to focus on inflation. That is the risk to the outlook right now. We need to see inflationary pressures start to come down in order for the US Federal Reserve to stop tightening policy so significantly, or stop on their path towards tightening policy so significantly, so that the cycle can ultimately continue. And then finally, I'm just going to conclude with some ideas around a framework for thinking about asset class implications. Of course, I know you work with very competent and well-established investment professionals to help you through that. So the first is, where are we in the cycle? You know, historically, business cycles in the United States can last 5 to 10 years. We've gotten used to these long business cycles, these long periods of time between recessions. If you look at what they look like, mapped out. These lines show you across the bottom how long each of these business cycles have gone, across the bottom to top, what type of advance you get in economic activity. And so these things tend to go on for a while. I'll give you just an example: 2009 through 2019, which is the line that goes the furthest but is the lowest. It shows you that that last cycle went on for over 10 years. It was a pretty modest growth environment, which some people didn't love, but a pretty modest growth environment turned out to be great for markets because you never really built the excess, the inflation, the concerns that tend to end cycles. Now, I would argue that that cycle would have kept on going had it not been for the coronavirus. And instead, what we're now experiencing is more of a pandemic like cycle, not a traditional business cycle. If you look at the line all the way on the left, the dark bolded blue line where it says 2020 through present, that is the experience that we've been dealing with since the beginning of 2020. An absolute collapse in economic activity. That's that line coming down meaningfully and then moving up very rapidly. In fact, compare it to any of these other cycles, it's a recovery the likes of which we largely hadn't seen, perhaps maybe with the exception of 1973 to 1981, but you just didn't have the collapse in activity before that. So this thing's only been going on, this cycle's only been going on, call it a little bit more than a year and a half, and we only have economic activity just now about 3% above where it was, but nonetheless, we're moving pretty quickly. We've had a bust and we've had a boom. And the way business cycles end, they tend to end with a lot of excess, they tend to end with inflation, and they tend to end with policy tightening, which is why we show the storm clouds moving over the US Federal Reserve building. Now, there's this old saying that cycles don't die of old age, they're ultimately murdered by the Federal Reserve with interest rate hikes, which is why we're all so focused on the inflation story right now and the prospect of the Federal Reserve tightening policy. Now, the good news is when we talk about excess, if you think about how we came out of the last recession, American households came out in good shape, not over-levered. Businesses came out in good shape. The banking system came out in good shape. So we don't have the type of excess that you usually feel late in the cycle, but we're dealing with inflation for very specific reasons, and we're dealing with policy tightening. When I say we're in good shape, the chart on the left is showing you whether businesses are over-levered. When the businesses have borrowed too much, that line is going up into those shaded areas which are recessions. Today, that's not the case. On the right are the banks tightening lending standards because the banks are worried about the health of the economy. When the banks tighten lending standards, that line goes up meaningfully, you have a recession. Today, that's not the case. So we're dealing with market volatility. Investors have some concerns, but nonetheless, these charts suggest to me that the fundamentals of the economy are intact. So what's the problem? The problem is that inflation is still high and rising. That's the chart on the top left. Inflation is at 7% year over year. And what happens when inflation is elevated is that the Federal Reserve starts to raise interest rates. Now, the chart on the right is a proxy for that. We're showing you in the light blue line, the 2-year Treasury rate. The dark blue line is the 10-year Treasury rate. As the Fed starts to lift short rates, the 2-year moves up towards the 10-year. And as those things converge towards one another, growth starts to slow meaningfully and tends to presage recessions. Largely because banks like to borrow short and lend long. When these two rates come towards each other, it's harder for the banks to make money and they lend less and the economy slows meaningfully. So what's happened more recently, if you look at the far right of that chart, the 2-year rate has moved up significantly, while the 10-year rate has moved up, but not by nearly as much. So you've seen a pretty big flattening of the yield curve. The good news is there's still a gap. There's still a spread. So the bond market is telling us that a recession is not imminent, but it does suggest that the risks are rising. That's what happens when inflation is elevated and policy is tightening. The risks start to rise. Now, bottom left, what else would we look for? Are borrowing costs for low-grade companies going up? A little bit, but not really. So the high yield bond market is behaving. Bottom right, the dollar is not strengthening meaningfully. So you have some warning signs here, but I take solace in the fact that top right, the yield curve has not inverted. Bottom left, borrowing costs for below investment grade companies remain benign. Bottom right, the US dollar has not strengthened meaningfully. That suggests to me that the business cycle continues. We have room to go. And the reason I care is because if I look at a stock bond ratio and I graph it along with business cycles, which are the shaded areas, the recessions, I find that a stock bond ratio tends to go up for the most part until we are heading into a recession. So as long as I'm right, and this is an economy that is not heading into a recession, it suggests to me that stocks should continue to outperform bonds. Now, there's always going to be some moments when this rolls over a bit, as it's been rolling over on the most recent data points. If you look at the last cycle, we saw that in 2011 with the European debt crisis. We saw it a little bit in 2015 with when the Fed first raised interest rates. We certainly saw it in 2018 with the US-China trade war. So it's not rare to see these things roll over a bit, but nonetheless, if we believe the cycle is going to continue, then we should expect stocks to outperform bonds. So my view is the risks of the cycle are elevated, but it's still a business cycle that should continue. Question two, what is the direction of the economy? We go through these different phases within a business cycle. If you think it's recovery, it's expansion, it's slowdown, and it's contraction. If you think about March 2020, that was a contraction. The rest of 2020 was a recovery. Last year was a boom expansion. I'm going to argue that this year is a slowdown. Right? So the economy is moving from an expansion to a slowdown. What does that look like? Before we get there, I want to suggest, slowdown may sound ominous, but let's remember that the economy in most areas has been absolutely booming. I'm going to look at 4 different charts, all that say very similar things, whether it's retail sales, whether it's building permits in the housing sector, whether it's business investment, whether it's job openings. In each of the charts, the first bar on the left shows you where we were heading into 2020. The middle bar shows you how bad it got in 2020, and the far right bar shows you where we currently are. In each of those instances, a bust, boom type of an environment, a contraction, the recovery up to where we previously were, and then an expansion above that level. And what I'm going to argue now is in most of these cases, you're going to start seeing a slowdown. What drives the slowdown? Top left, the household savings rate has come down meaningfully. Okay, look at how high the household savings rate had jutted up. Why did that happen? Many Americans made as much money as they had prior to the coronavirus as they did afterwards, but yet simply weren't spending money for a while for a variety of different reasons. As we all know, we weren't going to restaurants, we weren't commuting, we weren't going on vacations, right? So our savings rates went up. For those Americans who did not keep their job, they got an awful lot of government support. Our savings rates went up substantially. We unleashed a lot of pent-up demand on the economy, and our savings rates have come down meaningfully. Not to a scary place. The American consumer is not in bad shape, but this suggests to me that we've already spent a lot of our pent-up demand. Second, bottom left, real wages. We know it's a tight job market. We know that wages are going up because businesses are having a hard time finding people. Nonetheless, if you strip out inflation, our wage growth is still negative, meaning even though our wages are going up, they're not keeping pace with the price of with the increase in the price of goods. So on a year-over-year basis, our real wages are negative, which means we don't feel as good as consumers. On the right, government spending, the fiscal outlays. We spent $6 trillion in 2020 and 2021 to support the economy. That now starts to come down. So for all of these reasons, consumer slowing, Government spending is slowing. And this one, which I apologize if it's a little bit hard to read, but I would just consider, I'll just explain this real quickly. The dark blue line is basically a proxy for financial conditions. So is the Federal Reserve easing conditions, making it easier for everyone to borrow, or are they tightening conditions, making it harder? That line's coming down, the dark blue, shows you that the Fed is tightening conditions. When that happens, the light blue line, which is survey data in the manufacturing sector, starts to come down also. There's a pretty tight correlation between the two. And so no surprise, as the Fed tightens financial conditions, leading indicators of the economy start to roll over, pointing towards a slowdown. Now, the good news is that light blue line is coming from a very elevated level. Again, does not mean a recession is in the offing, but it does mean that the economy is starting to slow pretty meaningfully. Now, what are the policy implications for that? Everybody is focused on the US Federal Reserve for obvious reasons. I said earlier, cycles don't die of old age. They're ultimately ended by the Federal Reserve with interest rate hikes. So we need to focus on the Fed. What is the Fed doing and what is their intent here? The Fed is tightening conditions pretty significantly. Why? The Fed has a dual mandate. They want price stability and they want full employment. And as anyone who's been to a grocery store or a mall or has shopped online recently, they realize this is not a period of price stability, right? Prices have been rising. One way to think about it, and I hope this isn't too inside baseball, bear with me, I'll walk you through it, is the chart on the left, which is the bond market's expectation for inflation. The way to read this is the dark blue bars show you what the government is currently borrowing money at. So the 10-year, if you look at that dark blue bar, goes up to around 1.8. That's what the 10-year rate is. The light blue is showing you the yield on the inflation protected security. So what are investors willing to pay, or what yield are they willing to get on inflation protected securities? Those light blue bars are negative. Why? Investors are bidding up inflation protected securities. They're afraid. So, and as prices go up, yields go down. In this case, yields went negative. You subtract the dark blue from the light blue. So and you subtract the negative, you get a positive number. That's the bond market's expectation of inflation. Over the 1 year, it's 3.5%, 3-year close to 3.1, 5-year close to 2.9, 10-year 2.5. What's the takeaway? The takeaway is it's downward sloping. That's good. That means the bond market does not expect inflation to be a problem forever. The bad news is the 1 year is quite elevated, well above the Fed's comfort zone. And the Fed is very worried that inflation is going to become ingrained in our lives, that we're just going to keep expecting prices to go up and we're going to behave accordingly. That's what they're worried about. And so they want to raise rates until these inflation expectations come down. And they feel comfortable doing it because on the chart on the right, which is the unemployment rate, has come down meaningfully, right? So they feel like they've hit one mandate of full employment, and now they're working for price stability. What does it mean? The Fed's telling us maybe 5 interest rate hikes this year. So the good news is it seems like the market's priced in 5 interest rate hikes this year. The 2-year Treasury rate's already close to 1.25. So the market has gone forward to price in a lot of this, but nonetheless, rate hikes are blunt instruments and they're going to slow the economy down meaningfully. So we will all be watching closely to see if these inflation expectations start to come down, which will enable the Fed to back off its tightening cycle and the business cycle to continue indefinitely, which would be good for the equity market. The risks are rising, but I do believe inflationary pressures will ease. Why? You think about the risks to the outlook. Why do we have inflationary pressures? I think the best way to think about it is to look at what's gone on in the US retail sector. The dark blue line is retail sales. The light blue line is retail inventory. The gap between the two is an inventory to sales ratio. Businesses have been running an inventory to sales ratio for the last 30, 40 years of 1.5 times. what's happened? Go to the far right on this chart. That dark blue line has fell meaningfully. That was March 2020. Forget wanting to shop in March 2020. We didn't want boxes on our front step in March 2020 because we thought we had to wipe them down with Windex or Lysol or whatever else. So our spending collapsed. Then we realized, okay, we didn't have to wipe everything down. It's not a touch disease. And then we realized if we kept our jobs, we were going to have more money. And so we went on a spending spree. But look what happened to the light blue line, business inventory. As soon as we started going on a spending, as soon as businesses started to cut inventories, we went on a spending spree. And so the inventory to sales ratio closed rapidly. Every business in the world is trying to rebuild inventory, but they're trying to do it in a pandemic, which is very, very difficult to do. It's creating backlogs. It's hard to get deliveries. It's creating log jams. And as we all know, inflation is too much money chasing too few goods. And that's precisely what this picture is telling you. So how are we going to solve that? First, we'll start with the demand, the dark blue, then we'll start with the supply, the light blue. On the demand side, if you poll the American consumer right now and ask them, is it a good time to buy large household durables? On the left, things like furniture, refrigerators, stoves, televisions. I've never seen the answers worse. The American consumer is just saying, no, it's not a good time to buy. If you look at vehicles on the right, is it a good time to buy? I've never seen the answers worse, far worse than what it was during the global financial crisis. So that's the slowdown story. But here's what's critical. In an inflationary spiral, you shop now because you think prices are going to rise tomorrow. That's the case in Istanbul, Turkey right now. People in Turkey right now are spending today because they expect prices to rise tomorrow. This picture, or these pictures, is the exact opposite. The American consumer is saying, I don't want to spend as much right now. Things will be better in the future. That's the opposite of an inflation spiral. And it suggests to me that as our demand moderates, inflationary pressures will start to moderate. As inflationary pressures start to moderate, the economy and the equity markets should start to find themselves on better footing. Will it be volatile until we get there? Sure. Will the markets be not as good as they were in 2020 and 2021? Yeah, I suspect that's going to be the case. So you start to look for signs. Are some of these supply chain challenges easing? On the left, you survey people in the manufacturing sector and you ask them, talk to me about your supply deliveries. Are they slower? What percentage of you are saying they're slower? We were at 60% saying slower. It's come down to around 34%. Not perfect, but getting better. The cost of shipping things around the world, middle left, maybe peaked, we'll see. Semiconductor prices have come down. Far right, there was a lot of concern, even if we can get people back into the factories and we can get people in the emerging markets vaccinated, which they are now, 75%, can we get goods shipped? Once we get them shipped, can we get them off at the ports? Once we get them off at the ports, do we even have truckers to send them the next miles? We didn't, and people were afraid the truckers were never going to come back. They're coming back. Chart on the right is non-farm payrolls. How many people do we employ in the truck transportation sector? Almost back to pre-COVID levels. So we are going to work through these supply chain challenges as demand starts to moderate. And so finally, you think about what are the implications for markets. And we go through these questions for a particular reason because it starts to align with how we think about markets. So I'm going to start on the far right and talk about where we were in March 2020, a contraction environment, growth below trend and falling, monetary policy starting to ease. Remember how bad it felt in March 2020. In that type of an environment, you want to own government bonds. You want to protect yourself. Equities, bottom right, are your worst performers. To the extent that you own equities, you want to be really defensive, really low volatility. That lasted for a short period of time. We moved into recovery. Recovery was the rest of 2020. Growth below trend and picking up. Policy was still easy. That's when risk credit does best. Those borrowing costs for below investment grade companies comes crashing down, which is, or come down significantly, which is great. Equities are the next best performers. Within equities, you want to be more lower quality, you want to be cyclicals, you want to be deep value, small caps, anything that does well in an improving economic environment. Government bonds perform the worst because interest rates go up. Then we moved into expansion, growth above trend and picking up. Policy starts to think about tightening a bit. Equities still do very well. Think about last year. You want to own cyclicals, growth and value. Rising tide lifts all boats. Credit does well. Government bonds are your worst performers because interest rates go up. This year, slowdown, growth above trend, but coming down as policy gets tighter. Equities, despite the volatility, tend to still be your best performers. Within equities, again, you want to be more high quality, dividend oriented, lower volatility, structurally advantaged growth businesses. Credit tends to not do as well because the Fed's tightening things a bit. Government bonds do better than people think, your second best performer. So our view right now is we're in a slowdown. We think we'll be in a slowdown for a good part of the beginning of this year. The question is, do we move into contraction? Is that a roller coaster that we just fall off the cliff? Does the Fed have to tighten so significantly that we move into contraction? And that would be our playbook on the far right. Or do we start to see inflationary pressures come down? Policymakers start to say, okay, inflation's not as big of a concern. The American consumer start to say, okay, finally, it's becoming a bit of a better time to buy things. The pandemic hopefully becomes more endemic. People start to feel better. Can we move back into an expansion? And I suspect we can. But again, the risks are elevated. So my view is we're positioned for a slowdown. Our base case would say we will ultimately move back into an expansion at some point as things improve from here. But we watch with focus on whether we see signs that the economy is slowing too meaningfully. So Adam and everyone else, I will turn it back over to you. Let me just show my disclosures.
For those that can read really quickly.
Very much, Brian. That was really great. Now we're going to open it up for questions. If anyone has anything that they'd like a little bit more information on, the information that Brian has already talked about, and a little bit more clarification there, or any other questions, feel free to speak up.
Jane, go ahead.
I see that unemployment is going down, yet we can't find people who are willing to work, or we're closing businesses because we don't have the people to staff them. I just don't understand the differences.
Yeah, so the unemployment rate has come down meaningfully because, to your point, businesses are having a hard time finding workers. So, basically anyone who wants a job can get a job, right? And so the challenge is now that we've got a lot of open jobs. The question is, can we find more people to take those jobs? Basically, you have people that have left the labor force. You have people who have said, I don't really need to be in the labor force anymore. Will those people start to come back into the labor force to take those jobs? And so I suspect they will. I think what happened was, we had a pandemic. A lot of people, it is a nation where the population is aging, and a lot of people, when polled in their 60s and early 70s, suggested that they were going to continue to work for a long while. And the pandemic hit, and I think they kind of said to themselves, why do I need this? And the market went up for the next 2 years. Their housing prices went up for the next 2 years, and they felt pretty good about their situation. They felt, and the challenge now is we've seen equity markets more volatile. People have lost some money in the last few weeks. And you may start to see some of that cohort say, okay, maybe it's time to find my way back into the workforce. The other is you've seen a younger generation take advantage of very low interest rates to start businesses, their own businesses. You've seen a younger generation make an awful lot of money trading stock, trading cryptocurrency, different things. Why do I need your job if the value of my cryptocurrency is going up so substantially every day? And, I may be exaggerating a little bit, but, at some point, I expect the younger generation to recognize that they need a more consistent income stream than speculating on risk assets. And so you're likely to see more people come. The people that borrowed money at low rates to start businesses, not all those businesses are going to succeed. In fact, most of them won't. And borrowing costs are going up now. So I do think people will come back to the labor force. The other thing I think will happen is you'll start to see more automation of the jobs that people don't want. And you're already seeing that to some extent. You're seeing it when you check out at the pharmacy. You're seeing it when you check out at the supermarket. You're seeing it when you go to a restaurant. You may use a QR code to pull up a menu now rather than actually getting a physical menu. You're seeing that when you're calling for customer service, you're getting automated responses rather than people, which can be a little bit frustrating, but it's happening. So I guess in short, I would expect more people to come back to the labor force, and I would also expect jobs to become increasingly more automated over time.
And I think that, would you say wages with them increasing, that's going to be an attractive reason for some people to come back into the labor force too?
Excellent point. You entice them.
And there was a lot of stimulus, so people were getting a lot of checks.
Yeah.
And being rewarded to not work. That's kind of dissipated.
That's over.
Yeah.
That's over. Yep. I mean, let's remember, we 6 million people have gotten jobs in the last year. So, it's happening. It's just whether we're going to entice the rest of them to come back and take more jobs.
How about products on our shelves? We're seeing empty shelves everywhere.
Yeah. So the big challenge we have is the pandemic. And so we still have these rolling periods where people are not finding their way into factories. And that's in the emerging world, but it's also in the United States. And, one of the challenges we had in 2021, when the US consumer was roaring, you had big pandemics break out in places like Vietnam and Thailand. And at those points, vaccination rates in places like Vietnam and Thailand were 0%. Today, vaccination rates in places like Vietnam and Thailand are 75%. Not all that different than in the developed world. What we've also seen with Omicron in first in South Africa, then in the UK, then in the Northeast of the United States, is that cases go up quickly, tend to roll over relatively quickly, and people who are vaccinated and boosted tend to not have severe symptoms. In fact, in many instances, it seems actually better than what we had seen in flu seasons of past. So the hope is that as the pandemic becomes more endemic, meaning something that we all live with, you will see people return to the factory floors. And what I'm arguing, and the reason that I showed those surveys on the American consumer, what I'm arguing is that the American consumer is saying that we're not going to spend as much. And as we don't spend as much, as people can hopefully then as vaccinated workers can return to the factories, every business is investing in new ways to get inventory on shelves. What I think is it's going to start to level off over time. I actually view it not all that differently as 1947. Okay, why 1947? Well, US soldiers were returning from war. And they were forming households. And they needed dishwashers, they needed washing machines, they needed, any type of family household items. What were the factories doing the prior 2 years? Or the prior 4 years? They were building bullets and planes and fighter jets and bombs and everything else. And so what was inflation in 1947? It was massive. You could not get goods. And so what happened? Those factories had to evolve quickly, and they had to evolve to make consumer goods to match all of that demand. And they did. And inflation came down meaningfully. Now, it's hard to compare a pandemic to a war, but nonetheless, that's precisely what happened. And businesses need and are figuring out a way to get those factories moving again and to get the goods up significantly. If you want to be contrarian and you look at my charts, you may even say that a year or a year and a half from now, we may be looking at an oversupplied economy. Everyone's trying to rebuild inventory and the consumer saying no more.
It's kind of where my mind was going earlier.
Yeah.
Your chart, your last one that you showed the economic cycle. And in there, you're talking about, you think that we're in the slowdown. Maybe share with people how long you typically think a slowdown can last. I think people might be wondering, does that mean a month, 6 months? Maybe go into that a little bit.
Yeah, we've seen this before. I mean, look, I would say with the bad policy mix, a slowdown could throw you into recession, but it doesn't typically. Recessions tend to be pretty rare. We dealt with this in 2015. We had a pretty nasty slowdown when the Fed first started raising interest rates. We dealt with it in 2018 during the US-China trade war, if you remember. And those were both instances where I was nervous. The economy was slowing pretty meaningfully. And so what ended up happening in 2016 was Fed backed off the tightening stance, economy reaccelerated. In 2018, the Trump administration stopped with the trade war, all the uncertainty of the trade war, economy reaccelerated. And so it's hard to put an exact date or period on how long it lasts. It tends to reverse with a shift in policy. Now, we have two likely drivers of it. One is going to be reopening policy with regards to COVID. If China can start to move away from a zero COVID policy, if in the United States we start to travel more, we start to go to restaurants more, we start to get returned to the factories, you're seeing it more, right? But do we move to a greater reopening? And two, as I've talked about consistently throughout this presentation, when does the Federal Reserve feel more comfortable to back off a tightening stance? And so, we may be in a bit of a slowdown for a while here. Again, the question is, as we move later into this year, into next year, are we back expanding again, or are we talking about the end of the cycle?
And I think that's important for people to realize, is that, slowdown doesn't mean recession.
No. I mean, remember the early 80s, that there was the Coca-Cola commercial, the pause that refreshes. This could be the pause that refresh. We can't grow at these levels. There's no way we could sustain this. We've got 7% inflation because there's too much demand.
Mm-hmm.
So now we're going to slow down demand. We're going to slow down inflation. And the idea is that this is going to be a bridge year to get us back to a more reasonable level of growth and inflation. Can the Fed stick the landing? We'll find out.
You can't have interest rates so low and this massive growth continuing. It's not normal.
Right. Exactly.
Any other questions out there? Mary, you had your screen on before and it was a pretty cool background. I'm missing it now. Neve, do you want to add anything?
Yeah, the only thing I'll add is this. I've worked with Clute team, you folks, I think 17, 18 years now. So, I mean, that's the beauty of working with a really great financial advisor and a team that you folks are working with. We as asset managers will make investment decisions, macro decisions, but they have your game plan in mind and your personal needs in mind, irregardless of what the short-term environment's like. They're always going to keep the long-term approach. So you folks on the Zoom, you're working with a great team, and they take all this information and put together a plan that works best for you. So it's a pleasure partnering with you guys. And hopefully next time we see each other, it'll be warmer out.
Adam, I don't know that we introduced Neve.
We did not. My apologies. Neve is our connection, our wholesaler for Invesco. We've worked with him for a long time, and we always enjoy seeing him, even if it's virtually. So thank you very much for your thoughts, Neve.
You're welcome. And like I said, a pleasure working with you guys. You guys are great.
Thank you.
If anybody has any other questions, you can feel free to email them to us, to give us a call when we're in the office. We will have this replay up on the website if you want to take a look at it again. But thank you very much, everybody, for attending the webinar tonight. Thank you to Brian, to Neve, for being here and giving us lots of good information and answering some important questions for us. Oh, I do see a hand from Ben.
I think it's a clap.
I was on the lookout for a hand raise. So
Yeah, I think he's giving us, that must be for Brian.
Yes. Well, thank you very much, Brian, for the presentation and all the information.
My pleasure. Thanks, everyone. Be well.
Thanks.
Thank
You
you.
too.
Have a
Thanks,
great night.
Stay safe.
Bye.